In our last video, we talked about volume delta, the difference between the bid and the ask, and strike prices, and what to look for before we actually purchase an options. But we need to dig in deeper and actually figure out what are we purchasing, right? Because if you look at a stock, the stock shows the health of the company, right? So you can look at a stock, you can look at their PE ratio, you can look at their earnings report, all these other different things, and you can see exactly whereabouts it should be trading, the speculation where it could trade, and basically the stock price itself gauges that company. Well, with options, what we're doing is we mentioned before we're kind of trading as a coupon, but really what we're trading is we're trading the difference between the intrinsic and the extrinsic value. That's going to be two terms that we're going to define in this video. And what all that is we're going to trade speculation upon speculation. So if I know you are purchasing Amazon, that's what we have right here opened up, AMZN Amazon, because you like the company. So you're going to start purchasing, and everybody else around you and around me is purchasing Amazon because they like where the stock's going. They like the technicals, whatever behind it. Well, I'm going to purchase options because of your speculation, right? So my speculation is placed on top of your speculation. So that's how options work. But what are they made up out of? It's going to be the difference between the intrinsic here and the extrinsic value. So intrinsic is meaning anything that is considered in the money. So Amazon's currently what the last trade was 228.68. That's where we closed. So anything below there and under on the call side is going to contain intrinsic value. Anything above is going to contain extrinsic value. Because what does intrinsic value have? Well, it's the difference between where the stock is trading and the strike price that we place. So let's just say we're trading at an even number here, 228 Amazon. Well, if I purchase a $2 or I'm sorry, a $225 strike and my calls here for 525, well, at expiration, if all things being equal, Amazon stays at 228, I'm going to have $3 worth of intrinsic value in here. That's the premium that we're going after. So when we're talking about intrinsic value and extrinsic value, it's not only speculation on speculation, it's the premium, it's the cost in here that it is to purchase 100 shares at this certain price. So again, let me just reiterate that intrinsic value, it's going to be the stock price minus your strike price here, whatever it may be. In this case, 228 minus 225, that's the calls. And then the difference between those, that's going to be the intrinsic value. So if I purchase this call here, no matter how much I pay for it, 520 is currently what it's trading at, I'm still going to have $3 of intrinsic value in here. I'm not going to have the full $5 here that I'm actually purchasing. This is including with time and all those other things, right? So it's kind of, if you look at it, the coupon again, okay, the $10 hamburgers from McDonald's, I have an $8 coupon. What does that give me? That gives me $2 of intrinsic value currently. All right. So extrinsic value. So this is also, it's still premium, right? There's still options prices being traded out here out of the money. That's how it works. And the closer we get in the money, the price is going to increase. And the extrinsic value is made up of has nothing to do with the strike price minus, or I'm sorry, the stock price minus the strike price, any of that. It's all made up of speculation, which is going to be the volatility and then the time value. That's how you get your options pricing out here. So all the speculation out here of where they think Amazon will run to, right? That's where you're going to get your options pricing along with the time that it takes to get to a certain expiration date. So if we go out to March here, you can look at the 235 calls. They're trading at $4.65. So that's still pretty far out. So you still almost got 2 months or about a month and a half until we get to that expiration. And if you go to February here and your February 21st expiration date, you go to the 235, it's only about 70 cents because all that volatility, all that time is meshed up into that further dated options price, and that's where your extrinsic value is. So again, we already know what to look for when we're purchasing something: volume, our delta, the bid and the sell. We got to worry about the theta as well. But overall, what are we actually purchasing? In our options premium, we're looking at the difference between the intrinsic and the extrinsic value and the speculation upon speculation. So again, I will reiterate this one more time for everybody just to make it as simple as possible. It's going to be the stock price minus your strike price on the call side. That's going to be your intrinsic value. Anything above that stock price, all these strike points out here, this is all just volatility and time built in. That's the only way that you get all these options pricings out here. All right, guys, if you like this video, make sure to check us out on all of our social media. We also have a Discord service if you are interested, and you can find all of our socials in the description below.